Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by Callam Pickering, our economics writer. We're going to be talking today about the Aussie dollar, and particularly why the Aussie dollar is still tracking above that mid 75 cent range. Callam, what's really driving the Aussie dollar at the moment?
Well, I see it as being three key factors. The first is higher commodity prices. The Australian dollar has for a long time been largely driven by movements in commodity prices, particularly iron ore and coal. And now that those prices have increased over the past 6 to 12 months, we have seen the Australian dollar sort of firm against our major trading partners. The second factor is that the spread between Australian and US interest rates remains positive. That is, you can get a higher return investing in Australia compared to, for example, the United States, which makes Australia a popular destination for foreign capital. The third relates to the second, in that the Australian government bonds continues to have a AAA credit rating, which again makes Australia a popular destination for foreign capital. You combine those three factors and you can begin to put together a compelling narrative as to why the Australian dollar continues to be somewhat stronger than many analysts predicted.
Yeah, because some economists had been predicting the Aussie dollar would be closer to the 70 cent range by now. Is the Trump factor, does that have anything to do with it?
Well, in theory, the Trump factor should have driven the Australian dollar a little bit lower, and that's precisely what we saw following the election through to around the end of last year. In that it did drive the Australian dollar down towards 70 US cents, but since then it's really bounced back. The Australian dollar has appreciated against the US dollar by around 4% since the beginning of the year, and now we return back to that 75.5 level, which is where we fluctuated throughout most of 2016. So at this stage, I would say that the Trump factor really isn't having much of an effect on the dollar.
Against the pound, we're holding fairly strongly, obviously, because the pound has taken such a dive over the Brexit situation.
Yeah, that's correct. So the Australian dollar appreciated against the pound by almost 20% during 2016, largely due to Brexit. There hasn't been a great deal of movement throughout 2017 thus far. The Australian dollar is up slightly against the pound, but really not much price action going on at all. But I think it sort of brings together a broader point in that we tend to focus a lot on the US dollar, but the movements of the Australian dollar against a range of other currencies is very important. We have seen appreciations against the Chinese currency, for example, and that's really important because they're obviously our biggest trading partner. But we've also seen, a significant depreciation against the yen, for example. So there's lots of different dynamics going on behind the scenes.
Yeah, it's a good point, Callan, because obviously the Aussie dollar is trading against all currencies, not just the US dollar. That tends to be the one we focus on most. With commodity prices, there's uncertainty around, what will happen with commodity prices. We have seen some uplift. Where do you see the Aussie dollar going, if we do see a drift back in some of the commodity prices, particularly iron ore?
Well, certainly if we see a normalisation in commodity prices back to the levels that we saw in early 2016, for example, then I would naturally expect the Australian dollar to return down to around that 70 US cent mark. Most analysts expect that commodity prices will decline throughout 2017. It's just a matter of when. That said, commodity prices have proved to be somewhat more persistent than most analysts would have expected. So there's a fair bit of uncertainty going on in that space, and until we get some firm idea about whether commodity prices are going up or down, I expect the Australian dollar will continue to trade at around its current level.
But obviously exporters and including the mining companies would like the Aussie dollar to be lower than what it is, particularly as they lock in contracts.
Well, yeah, certainly Australian exporters would prefer the dollar to be low. Miners are probably okay with it because the strength in the dollar has come due to high commodity prices, and in net they're far better off than they are with lower commodity prices. Other parts of the economy, though, would certainly prefer the dollar to be somewhat lower. In an ideal world, they'd prefer a dollar below 70 US cents because traditionally that has been the market where the non-mining sector really begins to thrive from an export standpoint. But it certainly seems like we're not going to get to that level anytime soon.
So, in summary, you're expecting the Aussie dollar to remain fairly much around current levels for the time being?
Over the next few months, yes. I think most of the risks sit to the downside, particularly with regards to A, commodity prices, and B, the fact that the Federal Reserve is likely to hike rates. It's just a matter of when that occurs. Once those two factors begin to move, and if they move as I expect, then the Australian dollar should begin to decline towards US 70 cents.
Yeah, as you were saying before, part of the attraction for the Aussie dollar has been our interest rates, but once US rates start hiking up, that creates another channel for investors to go to.
Yeah, that's right, and it's actually quite interestingly poised at the moment. I'm going to put up a graph for this. It shows the spread between 10-year government bonds between Australia and the US, and what we can see is the spread's at its lowest level in well over a decade. At the moment, the spread between the two is only around 20 basis points. Now, historically, Australia has always needed a little bit of a premium over US government bonds in order to attract capital from overseas. But with only 20 basis points to spare, there is a real risk that the spread between the government bonds actually turns negative throughout this year, particularly once the Federal Reserve begins to hike rates. And if that happens, we could see quite a bit of currency depreciation that could quicken things up significantly.
So is that likely to drive an exodus of foreign capital out of Australia?
It certainly could. I mean, there's certainly a little bit of uncertainty surrounding that. One thing being that with Trump over there creating some political, economic uncertainty, the US may not be as attractive as it has been in the past, and so some investors may decide that Australia is perhaps a safer option at the moment while Trump's doing what Trump does. But historically, when spreads have turned negative, it hasn't been good for the Australian dollar. Usually there's a significant appreciation and capital does begin to shift elsewhere.
Oh, well, we'll leave it there for now, Callam. Thanks very much for that wrap up on the Aussie dollar.
Thank you.
I'm Tony Kaye. I'm the editor of Eureka Report. Thanks for joining us on Macro Monday.
InvestSMART Separately Managed Account Benefit number 54. In a separately managed account, you own the shares within your portfolio. Unlike a managed fund where you own units, you have beneficial ownership of the shares. This provides greater flexibility, visibility, and of course you get the franking credits directly. For more information, go to investsmart.com.au or download our free app